At the beginning of 2026, the trader went through one of the most difficult periods of his entire career. For nearly 2 months, he experienced continuous losses week after week in a market environment heavily influenced by extreme global events, political instability, unexpected geopolitical developments, and unprecedented news created market conditions that had rarely been seen before. These factors led to highly unpredictable price movements directly affecting his performance and resulting in a prolonged losing streak. Despite this challenging phase, he remained transparent by sharing every trade he took with his community. However, as losses accumulated, many people began to question his strategy and abilities. This situation highlighted a key issue. Most people fail to understand that trading is a long-term game. One of the most important principles he emphasizes is that there is no plan B during a losing streak. Changing strategy, adjusting risk impulsively, or trying to recover losses quickly often leads to even worse results. Instead, traders must remain disciplined, stick to their plan, and trust their system. He compares this to being stuck in traffic. When there's no alternative route, the only option is to stay on course and continue forward, even if it means arriving later than expected. Similarly, in trading, consistency and patience are essential. By maintaining proper risk management and a positive risk-to-reward ratio, profitability will eventually come over time, even after a series of losses. After enduring this difficult period, the trader entered a 3-week winning streak, generating approximately $150,000 to $160,000 per week. What's particularly important is that he did not win more trades than he lost. Instead, his profitability came from the fact that his winning trades were significantly larger than his losing ones. This demonstrates the power of a well-structured strategy and disciplined execution. A fundamental concept he stresses is that every trade must be treated independently. Whether a trader has just experienced multiple wins or losses, the next trade should always be approached with a neutral mindset. Emotional bias, such as overconfidence after wins or fear after losses, can negatively impact decision-making. Each trade is unique and should be evaluated based solely on current market conditions, not past outcomes. To maximize a winning streak, he advises traders not to constantly tweak their strategy. Instead, they should identify what is already working and double down on it. For example, if success comes from trading specific sessions or time frames, they should fully commit to those conditions rather than trying to expand or optimize unnecessarily. The goal is to maximize the effectiveness of proven methods rather than constantly searching for improvements. Another critical factor is controlling ego. Ego can prevent traders from accepting mistakes or recognizing areas for improvement. Many traders fail because they blame external factors for losses or believe they have mastered the market after a period of success. This mindset limits growth and can lead to significant setbacks. Remaining humble and continuously learning is essential for long-term success. The trader also shares real examples of his trades, including both wins and losses. His approach remains consistent. He places stop losses at levels that invalidate the trade idea and targets a fixed risk-to-reward ratio, typically 1:2. Even when a trade moves further in his favor, he does not deviate from his plan. This discipline ensures consistency and prevents emotional decision-making. He also emphasizes the importance of accepting losses. Losses are not failures, but part of the process, as long as they are controlled and aligned with the strategy. What matters is that overall, the winning trades outweigh the losses. Another key takeaway is the principle of quality over quantity. Over a 3-week period, he only executed 4 trades, focusing on high-probability setups rather than overtrading. This selective approach reduces unnecessary risk and improves overall performance. Finally, he highlights that nothing in trading should come as a surprise. Every trade is planned in advance with predefined risk and expected outcomes. Traders should not be shocked by losses, as risk is always calculated beforehand, nor should they be surprised by profits, as generating returns is the objective of trading. Success comes from following a structured process, where profits are simply the result of disciplined execution over time. In conclusion, the trader's experience demonstrates that success in trading is not about avoiding losses, but about managing them effectively, maintaining consistency, controlling emotions, and trusting a proven strategy.